Morningstar's manager research has a very disciplined framework. It is a framework, not a formula, but it gives our analysts across the world a very clear structure on how to approach a fund.
We frame our research around 5 key pillars. They're people, process, parent, performance and price. We've got over 100 fund analysts globally, and what this does is set a consistent framework around the factors we believe are important. We've been carrying out qualitative fund research now for over 20 years and believe these are the really important aspects that allow you to analyse the ability for a fund to deliver a good investor experience.
Morningstar has done tons of studies on the predictive power of fees. Fees are the single greatest predictor of future performance. And by buying low-cost funds, investors increase their odds of success. This is why we scrutinize ongoing charges and other costs and reward the least expensive funds in each investment category. Most index funds and ETFs have a cost advantage relative to the active peers because they are low cost, and we reflect that in our analysis and our ratings.
Analysis of the parent company, and by that we mean the fund group itself, is often overlooked, but we think it's important because sometimes a bad asset management company can feed through and overwrite a good fund. Investor-friendly traits we look out for. We tend to look for asset management groups that show they can control flows as funds are nearing capacity. A longer time period over which a fund manager's bonus is assigned is also very important to us. Essentially, it's about stewardship rather than salesmanship.
The people pillar is about assessing the people managing the portfolios. So when we interview fund managers, we try and understand the quality and the longevity of their experience, and it's relevant to the investment process. We need to be cognizant that an experienced manager doesn't always mean a good manager, but our assessment does not stop there. We also look at their support network, we meet the analysts, we meet the risk management team and understand how they interact with the managers and how well all of this fits together. We look for strong stewardship and alignment of interests, and thus have a bias towards managers who invest in their own funds and view fund holders as their partners.
When we assess performance, we look to see whether returns are in keeping with our expectations, given our understanding of a manager's investment approach. Also, are those returns actually strong enough in the context of the degree of risk that's been taken? So we're looking at risk-adjusted returns.
Assessing the investment process involves a large amount of due diligence. We interview all fund managers on a regular basis, looking to understand the research, decision-making and portfolio construction processes behind their investment style. In general terms, we prize processes that exhibit detail, rigour, clarity and consistency of approach. The aim is to build a comprehensive picture that goes beyond the broad philosophy and allows us to truly differentiate between strategies.
The rating scale at Morningstar allows us to express a clear opinion. We think that's crucially important and reflects our independence when providing investment research. The final output of our research process is then our 7-page global fund report. Our reports go beyond just explaining the rating and also talk in depth about what an investor should expect from a fund, characteristics of the process, how it might behave in different market environments, even how a fund's differentiated, for example.